DiamondRock Hospitality just delivered, honestly, a massive earnings beat for the second quarter of 2026. I mean, they completely crushed consensus estimates across the board.
Yeah, they really did. The numbers are incredible.
Right. So top-line revenue came in at $318.3 million, which is up 4.1% year over year. But net income, that skyrocketed to $0.44 per diluted share.
Which is a staggering 144.4% increase, by the way.
Exactly. But, the metric that really drove the market reaction, especially considering they have a $2.5 billion common equity capitalization, with the stock closing at $12.18 on June 30th, was their adjusted funds from operations.
Right, the FFO.
Yeah, adjusted FFO hit $0.44 per diluted share. That's a 25.7% jump from the same quarter last year.
And management totally doubled down on those results, too. They went ahead and raised their full year 2026 guidance.
Oh, they did?
Yeah, they now expect adjusted FFO to land between $245.5 million and $255.5 million. So that translates to like $1.18 to $1.23 per share.
That is a very confident signal.
It gets better. To signal their absolute confidence in all this free cash flow their portfolio is throwing off, the board declared a 22% increase to the regular quarterly cash dividend.
Wow.
Yeah, bringing it to $1.11 per share.
Okay, so the numbers are undeniably strong. But our mission today for this deep dive is to step back and look at the underlying mechanics.
Right. Look under the hood.
Exactly.
Yeah.
We are pulling directly from DiamondRock's Q2 earnings call, their 10Q filing, and management's latest commentary to really dissect their segment performance. Because for you, the retail investor holding hotel REITs, we need to figure out if CEO Jeffrey J. Donnelly's DiamondRock 2.0 strategy is a fundamental shift in how they generate yield, or if they just, got a lucky break.
Well, look, when a lodging REIT posts a 25% jump in adjusted FFO on merely 4% revenue growth, the underlying machinery is operating at maximum capacity.
Yeah, the math is wild.
Right. The real story isn't just how much money came in the door, it's how effectively they routed every single dollar through the property level and straight down to the bottom line.
Okay, let's unpack this top-line revenue growth first, because that is where the engine starts. I look at a 4.1% total revenue increase, and frankly, that feels a bit pedestrian for a premium hotel portfolio.
It sounds a little low on the surface, yeah.
Right. But we have to look deeper into the operating statistics. Their comparable RevPAR, which is revenue per available room, actually jumped 7.0% to $240.79.
That's a huge metric to watch.
It is. And comparable total RevPAR, which factors in all the extra spending, like food, beverage, resort fees, that increased 5.6% to $370.06.
And the components of that RevPAR growth, they really show us the pricing power they currently hold. I mean, their average daily rate, the ADR for the comparable portfolio, hit $308.50.
Which is up 4.6% year over year.
Exactly. And simultaneously, occupancy climbed to 78.1%.
That's the dream scenario right there.
It really is. In the hospitality business, pushing your nightly rate above $300 while still putting more heads in beds, that's the gold standard. It means you aren't sacrificing volume for price. The demand curve is just strong enough to support both simultaneously.
I hear the optimism on demand, but I have a major pushback on the quality of that revenue.
Okay, let's hear it.
So on the earnings call, the CEO specifically cited a beneficial tailwind from the World Cup in several of their key markets.
He did, yeah.
And whenever management points to a global sporting event, I immediately think of a sugar rush.
A sugar rush?
Yeah, you get this massive temporary influx of international tourists. Nightly rates just go through the roof in those specific cities for like 3 weeks, and your quarterly numbers look phenomenal.
Right, right.
But a sugar rush isn't sustained nutrition. So I have to ask, is this top-line growth just a sports-induced anomaly that's going to completely vanish by Q3?
Well, what's fascinating here is that management clearly anticipated that exact skepticism from the institutional analysts.
They thought coming.
Oh, absolutely. Donnelly explicitly addressed the World Cup effect in his commentary to front-run the narrative. He acknowledged the tournament provided a high-margin tailwind, but he mapped out how the quarter's performance reflected structural, broad-based demand rather than just some localized spike.
Okay, explain the mechanics of that broad-based demand then. Like if the World Cup was just the cherry on top, what was the actual sundae?
So the core nutritional value comes from how group bookings interact with transient leisure demand across their 34 premium hotels.
Right.
A hotel operator wants to secure large corporate groups and conferences months in advance, right? These group bookings act as a base load. They fill up maybe 40% to 50% of the hotels.
So you have half the building paid for before the month even starts.
Exactly. And once that baseline is secured, the hotel has fewer rooms left to sell to everyday transient travelers. This creates what the industry calls compression.
Because supply is artificially tight.
You got it. Because supply is tight, their revenue management algorithms can aggressively jack up the daily rates for those remaining rooms.
Oh, I see. Yeah. DiamondRock didn't just see a spike in the few cities hosting soccer matches. They saw really strong group bookings across their top gateway markets and premium leisure destinations.
Which created localized compression everywhere.
Exactly. And that allowed them to push that average daily rate up to $308.50 portfolio-wide.
Okay, so the demand architecture is structurally sound. I get that. But generating top-line revenue is only half the battle.
Right. You have to keep the money.
Exactly. In the service industry, making an extra dollar of revenue is meaningless if it costs you $1.10 in labor, utilities, and supplies just to service the guest.
Yeah, inflation is a killer.
Right. So the flow through from top line to bottom line is where this earnings report gets absolutely wild.
It really does. Because the company held their overall comparable hotel expense growth to an incredibly tight 1.8%.
Which is just crazy in this environment.
It is the defining metric of this entire deep dive. When you pair 7% RevPR growth with 1.8% expense growth, the resulting margin expansion is explosive. Yeah, I mean, their comparable hotel adjusted EBITDA margin expanded by a staggering 457 basis points.
Hitting 35.76%.
Right. Expanding operating margins by over 4.5% in a single year, especially in an environment where wage inflation has been punishing the service sector that's practically unheard of.
It's a massive win.
It is, but, we need to play referee here.
Yeah.
There is a massive caveat in the 10Q filing that heavily distorts that 457 basis point number.
Ah, you mean the Chicago property tax settlement?
Exactly. In May 2026, DiamondRock successfully finalized multi-year property tax appeals for two of its major assets in Illinois. The Chicago Marriott Downtown Magnificent Mile and the Gwen.
Right.
And that legal settlement resulted in a one-time cash benefit of approximately $6.9 million, which they recognized entirely in this second quarter.
Just dropped it right onto the balance sheet.
Yeah. A property tax appeal basically means the city overassessed the value of their hotels in previous years, they fought it in court, and finally got a rebate. So my question is this incredible margin expansion just an accounting mirage created by a retroactive legal victory?
It's a fair question, but honestly, even if we strip out the noise of that $6.9 million one-time windfall, the underlying operational story remains incredibly bullish.
How so?
Because excluding the Chicago tax benefit entirely, their comparable hotel-adjusted EBITDA margins still increased by 239 basis points.
Wow. Okay, so generating nearly 2.5% of organic operational margin expansion is still a massive victory for the management team.
It is a masterclass in cost control, especially when you contextualize it within current macroeconomic realities.
Yeah, inflation is everywhere.
Right. We are looking at a highly inflationary environment where labor costs, housekeeping, front desk staff, maintenance crews, they are relentlessly pushing upward. To keep total expense growth pinned at 1.8%, you have to fundamentally change how the hotel operates.
You can't just keep doing things the old way.
Exactly. And you can see the evidence of this in their food and beverage numbers. Their F&B revenues increased to almost $80.8 million for the quarter, but their F&B expenses were virtually flat year over year, coming in at $50.8 million.
See, that's what I want to know about. How exactly are they pulling that off mechanically?
It's a mix of strategies.
Are they just running skeleton crews to impress Wall Street? Because as an investor, that raises a major red flag. You can only squeeze your labor force and defer property maintenance so much before the guest experience ultimately suffers.
Right. You don't want bad reviews.
Exactly. If service deteriorates at a premium resort charging over $300 a night, those bad reviews pile up fast, and you instantly lose your pricing power. Is this DiamondRock 2.0 just, corporate spin for cutting corners?
That is the perpetual tension in hospitality real estate, right? Long-term brand equity versus short-term cash yield. But the operational data suggests they are achieving this through structural efficiency, not deferred maintenance or understaffing.
Okay, give me an example.
Well, management is leveraging technology and dynamic labor models alongside their third-party operators. So instead of scheduling fixed 8-hour shifts for housekeepers regardless of the day's checkouts, they're using predictive algorithms to match staffing hours perfectly to the daily occupancy curve.
Oh, that makes sense. So they aren't paying people to just stand around.
Right. And they are implementing automated check-in kiosks that reduce the required headcount at the front desk without slowing down the guest experience.
Makes check-in faster, actually.
Exactly. And on the food side, they're streamlining their F&B menus to reduce prep-heavy items that require massive kitchen staffs while utilizing centralized procurement software to negotiate better vendor contracts on supplies.
Okay, so it's a structural overhaul.
It is. And the proof that this isn't destroying the guest experience is right there in the ADR. If service was dropping, guests would absolutely refuse to pay higher rates, but DiamondRock successfully pushed rates up 4.6%.
That's a great point. And expanding margins while protecting pricing power translates directly into cash generation.
Cash is king.
It is. Because operations squeeze so much efficiency out of their revenue, DiamondRock's free cash flow has surged 30% over the trailing 12 months.
That is a massive jump.
Yeah, and that brings us to the most critical aspect of the DiamondRock 2.0 strategy. Generating cash is great, but how management allocates that cash determines long-term shareholder value.
Absolutely. Their capital allocation strategy is highly disciplined and functions on three distinct pillars.
Break those down for us.
Sure. It's pruning the portfolio of capital-heavy assets, aggressively reinvesting in the core properties to protect pricing power, and returning excess liquidity directly to shareholders.
Okay, let's focus on pruning the portfolio first, because, wait, I need you to clarify something for me.
What's up?
I am looking at the 10Q filing regarding their disposition activity. On May 1st, they completed the sale of their interest in the Courtyard, New York, Manhattan, Fifth Avenue.
Right, the Fifth Avenue property.
It's a 189-room hotel in the middle of Manhattan, and they sold it for just $33.0 million.
Seems low, right?
Yeah, for prime New York City real estate, it sounds like they dumped it for pennies on the dollar. What am I missing here?
You are missing the land underneath the building.
Nah.
Yeah, DiamondRock didn't own the property outright in fee simple. They owned a leasehold interest. This means they own the hotel structure, but they were renting the dirt it sat on from a third-party landlord.
Which is a whole different ballgame.
Completely. Ground leases in commercial real estate typically have contractual step-ups where the rent escalates significantly over time. As that ground rent rises, it severely compresses the net operating income of the hotel.
Oh.
And furthermore, as a leasehold approaches the end of its term, its value practically drops to zero because the building eventually reverts to the landowner.
So they were holding a depreciating asset with an escalating liability attached to it.
Precisely. The headline sale price was a 6.3 times multiple on the hotel's projected 2025 adjusted EBITDA. But the hidden genius of this disposition is what they avoided by walking away.
What did they avoid?
By offloading this specific property, they entirely avoided $12 million in required, brand-mandated capital expenditures that were going to hit their balance sheet over the next 12 months.
$12 million just to keep the flag on the building?
Exactly. And on top of the ground lease increases, they were also projecting significantly higher localized labor costs in that specific New York market over the next several years.
So it was just a cash drain waiting to happen.
Pretty much. When you factor in the $12 million in avoided capex, the stabilized capitalization rate on the sale was actually closer to an implied 7.8% yield.
Here's where it gets really interesting. Think of their capital allocation like pruning an oak tree to make it grow stronger.
I like that analogy.
Yeah, management identified this New York leasehold as a dying branch. It was low yield, capital intensive. It was about to absorb $12 million in vital nutrients cash just to maintain the status quo while getting strangled by a rising ground lease.
Exactly.
By chopping that branch off, they instantly redirect all that cash flow to the healthiest, highest yielding parts of the business.
And they're aggressively directing those nutrients back into the core portfolio. During the first 6 months of 2026, they invested $40.3 million in capital improvements, and they expect to deploy between $75 million and $85 million for the full year.
That's some serious reinvestment.
It is. They recently completed comprehensive guest room renovations at the Courtyard, New York, Manhattan, Midtown East, and the Henderson Park Inn. And looking at the back half of the year, they're launching a major lobby and entrance renovation at the Westin San Diego Bayview, alongside a full guest room overhaul at the Atlanta Marriott Alpharetta.
Which answers my earlier worry about deferring maintenance. You don't spend $85 million on renovations if you are cutting corners.
No, definitely not.
You invest that capital to keep the physical product premium, which is exactly how you justify charging your guests over $300 a night.
Right, it feeds the pricing power.
But, management isn't just buying new carpets and lobby furniture. They are funneling a massive chunk of this cash directly back into the pockets of the retail investor.
Returning value, yeah.
We already touched on the 22% dividend increase, taking it to $1.11 per share quarterly. But the share repurchase authorization is where they are playing real offense.
Oh, yeah. On April 28th, the board of directors authorized a brand new $300 million share repurchase program, effectively replacing and expanding their old $200 million authorization.
That's a huge bump.
It is. And in the second quarter alone, they executed on this by buying back 0.2 million shares at an average price of $9.79 per share.
Which is really an execution. The stock closed the quarter at $12.18.
Right.
By stepping into the open market and buying their own stock at $9.79, management essentially acquired their own premium hotel assets at a 20% discount to what the broader market decided they were worth on June 30th.
It's free money for them.
Exactly. When a company retires shares at a steep discount, it mathematically increases the proportional ownership and the FFO per share for every single investor who holds onto their stock.
It is the ultimate flex of capital discipline. They sell assets with impending capital burdens, reinvest in the assets with the highest return on invested capital, and buy back their own equity when Wall Street temporarily misprices it.
Playing offense with $300 million buybacks is exciting, sure. But in a highly cyclical industry like hospitality, playing aggressive offense requires an ironclad defensive perimeter.
Absolutely, things can turn fast.
Right. If global travel demand drops tomorrow, how thick is their armor? If we are going to evaluate the true safety of the DiamondRock 2.0 strategy, we have to stress test the balance sheet against macroeconomic risks.
Definitely. If we connect this to the bigger picture, lodging REITs are uniquely vulnerable to economic shocks because they are highly sensitive to daily rate fluctuations combined with sticky labor costs.
I always explain it to people like this. An office REIT with 10-year corporate leases is like a freight train. It moves slowly, it takes a long time to speed up, but it stays on the tracks and keeps rolling forward even if you take your hands off the wheel for a minute.
That makes sense.
But a hotel REIT, however, is a fighter jet. You are literally leasing your real estate fresh every single morning.
Every single night.
Right. So if consumer demand suddenly drops, your revenue plummets at Mach 2, but your fuel costs your baseline property taxes, insurance, and minimum labor requirements, they're still burning just as fast.
That fighter jet analogy is perfectly accurate. Because a hotel's top-line revenue can evaporate overnight, the debt profile is your ultimate safety net.
So how does DiamondRock's safety net look?
Pretty strong. As of June 30th, DiamondRock had $1.1 billion in total debt outstanding. The critical detail here is that this debt consists of unsecured term loans with a weighted average interest rate locked in at 4.9%.
Having a 4.9% fixed rate shield in an environment where the cost of capital has spiked dramatically over the last few years is a massive competitive advantage.
It really is. It means their debt service costs are entirely predictable.
And looking at their liquidity, I don't see any immediate crisis on the horizon. They are sitting on $106 million in unrestricted cash, plus they have an entirely undrawn revolving credit facility with $400 million in available capacity.
So plenty of runway.
Yeah, that gives them over $500 million in total dry powder to weather a storm or deploy into a distressed acquisition.
The balance sheet is undoubtedly a fortress right now, but management is legally obligated to outline the storm clouds gathering on the horizon.
Oh, what are they worried about?
If you read through the risk factors in their 10Q filing, they explicitly highlight macroeconomic conditions that could derail this current operational momentum. They specifically point to evolving geopolitical conditions in the Middle East, ongoing domestic inflationary pressures, incredibly tight labor market conditions, and the lingering uncertainty regarding exactly when and by how much the Federal Reserve will adjust interest rates.
And those aren't just boilerplate warnings. If inflation remains sticky and the Fed holds rates higher for longer, it eventually breaks the consumer.
Yep, the money runs out.
Right. A tapped-out consumer means fewer family vacations to premium resorts, and tighter corporate budgets mean fewer business conferences.
Which brings us right back to the margin expansion. Their 4.9% fixed-rate debt provides a solid shield, but any sudden macroeconomic shock that kills leisure travel or halts business group bookings will severely test that 1.8% expense control.
Because you still have to pay the housekeeping staff, even if the hotel is half empty.
Exactly. If revenue stalls and RevPAR flattens out, maintaining those 35% margins will require management to find entirely new, unprecedented ways to cut costs in a system that they have already optimized to the absolute limit.
So what does this all mean for you, the investor? The DiamondRock 2.0 strategy appears to be executing exactly as CEO Jeffrey Donnelly promised.
It really is firing on all cylinders.
Yeah, they are combining ruthless capital discipline, like cleanly amputating that capital-heavy New York leasehold with extreme operational excellence at the property level. They have proven they can grow free cash flow by 30% by fundamentally changing their cost structure rather than just relying on one-off tailwinds like the World Cup.
And returning that cash to shareholders.
Exactly. Returning that optimized cash flow directly to you through a 22% dividend hike and an aggressive $300 million buyback program, all while maintaining a fortress balance sheet with over $500 million in liquidity.
It is a remarkable, highly technical quarter, but I want to leave you with one final thought to mull over as you look at your portfolio.
Go for it.
DiamondRock proved this quarter that they can squeeze an astonishing 457 basis points of margin expansion out of single-digit revenue growth through pure technological and operational efficiency. But if those macroeconomic pressures they outlined in the 10Q finally crack consumer travel demand and RevPR actually turns negative next year, will this highly optimized version 2.0 operating model have any more fat left to trim?
That is a scary thought.
Or has management already pulled every single lever available to them?
That is the multi-million-dollar question for anyone holding the stock through the next cycle. Thank you for joining us as we unpack the mechanics behind DiamondRock's Q2 earnings. Be sure to follow the show for daily, no-nonsense earnings coverage right here.